It is time for markets. So joining us on that is Bill Strazzullo, partner and chief market strategist at Bell Curve Trading. Thanks for joining us today.
My pleasure.
Bill, you were very bullish on the markets before, but you have kind of changed your tune. Tell me why.
Yeah, it changed dramatically, Marella. We were one of the most bullish firms on Wall Street 2023, 2024. On this network, early 2024, mid 2024, I talked about the S&P going to 6,000. The NASDAQ 100 going to 22,000, 22,500, the Dow going to 45,000. That was at a time when people were still looking for recession, and we weren't sure what, if any, rate relief we were going to get for the Fed because inflation was still elevated. You fast forward, you hit all our targets. And so I've been really the lone voice of sanity for months now in this network and others saying and telling viewers that the market's topping out. And there's two main catalysts here. The first catalyst is the key long-term trend driving the market higher is the rally off the March 2020 lows. That's in the height of the pandemic when we started the historic monetary and fiscal stimulus. I've done hundreds of interviews over the course of my career. You ask people that come on these shows, 99 of 100 say they're long-term investors. Ask them what the long-term is. Is it 3 years ago, 5 years ago, 1929? What is it? And most people have no idea. The key long-term trend that's driven this move higher is the rally from the pandemic lows in March of 2020. And when you look at that key trend across the major indices in the U.S., it's tapped out. And so that was something that allowed us to have the targets months in advance and tell your viewers months ago that we're basically, this rally was over. The second key catalyst was something that we didn't know, back in mid-2024, and that's the Trump administration, which has had every ill-conceived policy you can think of. Tariffs, deportations, extension of the 2017 tax cuts. All these things either hurt the economy, stoke inflation, or both. So we have two really profound catalysts here. The long-term trend basically tapping out, and then secondly, an administration in the White House that is catastrophically incompetent.
Okay, so let's talk a little bit more about current circumstances, which is, a trade war, which is ebbing and flowing sort of minute by minute as we go. And I'm wondering, our government has talked about supporting or putting in supports for certain sectors and people who might be affected by this, should this go, longer term. And I'm sure your government would have to consider the same. So how do you factor in that sort of fiscal policy, and does that sort of reset the timeline?
It's already caused enormous damage. First of all, it makes no sense whatsoever, Marella. I've had my own business for 20 years. The idea that you would go to our best trading partners and then harass them and make their life miserable makes no sense. It just makes absolutely no sense. And so, whether Trump stops now or he continues with the threat, I think the damage has already been done. I mean, the uncertainty and the fear. I mean, people focus on the economic statistics. We're going to have non-farm payroll tomorrow, big number. But to me, the most important thing to focus on, at least in the U.S., over the last several weeks, is look at all these town halls across the U.S., even in deep red Republican districts. People are terrified. They're terrified of what the administration is doing with the tariffs, with the cutting of federal jobs. So I think a lot of the damage is already done. And, the question really from here is how low do we go? And just like I talked about on my interview on BNN on December 30th, that the market was topping out, and that was a totally novel contrarian view. What I'm going to give you viewers today is I think the bottom here is a lot lower than people anticipate. I think top to bottom, at least in the U.S., we'll be lucky if we get out of this and we're only down 20%. So my message to the viewers is just like our message to our clients, and we advise some of the largest hedge funds, mutual fund complexes, and pension funds all over the world, pump the brakes. Take the exposure down. You're going to get a much better chance to deploy that capital later in the year.
Got it. Okay, so that's, I'm glad you're serving it up straight up, but I'm sure a lot of people are very nervous about what's ahead. And I do want to get to your forward-looking information, because you've looked at the American markets and what they should or could look like down the road. Let's start with the S&P. Tell me what you see there.
Yeah, look, I've been on this network for months saying that we were going to top out around 6,000. The high's been, I think, 61.47, something like that. And we've had a significant sell-off. To me, the upper end of the range here, you could still push it to maybe 62, 6,300. But I think the lower end, could be as deep as 4,500. So the exercise, Morella, isn't about trying to top ticket. It isn't about trying to say what's going to be the high print on what day. That's a loser's game. You're right once, you're wrong 1,000 times. The real exercise is to know at what point in the trend do we have as much or more downside than we do upside. And because at that point, it becomes a coin toss. And so, yeah, I mean, could the market rally from here? Sure. But you're talking about minimal. All right, the downside is much greater than the upside. And that's the point I'm trying to get across and have been trying to get across for months, that we've got a lot more downside here than upside. And again, I think it could be a lot more than people anticipate. As I said, if we get out of this and we're only down 20% top to bottom, we'll be lucky. You have a major long-term trend tapping out. You've got an administration in Washington that seems intent on not only a trade war, but starting a recession. And so I just think, people still have had really good gains from 23 and 24. Take some of that money off the table. You'll have a better opportunity later in the year to put it to work.
Okay, I just want to get to your NASDAQ and Dow as we wind up the conversation, just so we get a look at that. Can you walk us through those forecasts?
Sure. The NASDAQ 100, our target was like 22,000, 22,500. That's right where the market's topped out. Again, here, I think we could go considerably lower. Easily we could top to bottom be down 20%. So, and you see it already with the Magnificent Seven and a lot of these high-flying tech stocks. They're the ones that soared on the way up. The ones that, skyrocket on the way up are going to get hurt most on the way down. So the NASDAQ actually probably is going to be more vulnerable than the S&P. I mean, there's potentially even more downside there. The Dow has kind of been the laggard. So, it generally doesn't go up as much on the upside. And so the downside probably won't be as bad, but still that's going to get hit hard. And so my bigger message to the people watching the show is we've been spoiled over the last few years. Whenever we have a sell-off, it's like 10%, and then we V-bottom and go right back to the top. We're in a totally different environment here now. Again, the long-term trend is tapped out. A mean reverting move on that could easily be 20% lower.
Bill, I got to let it go because we got to catch the markets. Thank you so much for your time. Appreciate it.